Okay traders, welcome to your new video tutorial. This one I think covers a multitude of different angles when it comes to looking at gold, right? So the way I see gold move, the way I see the market move in general, the way or where I place my manipulation points, my levels, whatever you want to call them, and then how I generally try to go and tackle the market and how I see structure and price action. Okay, so the first thing is I see, so the market moves in cycles. We've got a basic, well, we've got a couple of different videos on market cycle in the education part of Discord, right down the bottom. Market will basically accumulate, okay, and then move impulsively. Once there's enough orders in the accumulation, it will break out, move, accumulate, break out, move, accumulate, and then it will stop, and then it will start to pull back, and then it will reverse. So there are different ways that we can look to tackle this, because we don't want to be getting involved in these accumulations, right? And gold is notorious for accumulation, breakout, impulsive move, and when it moves, it moves, right? It will move sometimes 100, 200 pips in a matter of 20, 30, 40 minutes. So in order to be able to, jump on those trends, we have different variations of how we can tackle it, right? So we got some minor structural ideas here. Okay, you've got more of a square box accumulation, and then what you'll notice here is we've got an accumulation where we start to make higher lows before we potentially break out, and then we've got the opposite, okay, where we start to make lower highs. Okay, and if you can identify these regularly on maybe the 30-minute or the 15-minute time frame, sometimes the 1 hour, then there's a lot of moves that you're going to catch over the course of the next couple of months, couple of weeks, however long it is that you're here with me in GFX. Okay, so the first thing I want to do is I want to mark off my levels, okay? And you all know me by now. I always round up the number to the nearest 60, and I am trying to pay as much attention as I can to, whether or not this would be 24.49, 200, and just without any digits, so it would be treble zero at the bottom, or 500. Obviously for the case of this video I didn't quite manage that, but I do like to use round number psychology, so you can always bear that in mind when you're trying to pick your levels on high time frame or whatever as well. So what we've got is I will place if this is the first accumulation and we've got a move up here, okay, I'll always mark the top of this, because if price is going to come back, it's going to come back to this accumulation, it potentially come down, bounce off it, and go again, right? When we've got an accumulation like this, I'd always try to mark the low of it, and potentially, I'll mark the top of it as well, okay? And there's a reason for that, and there's also a reason why I do it on here, okay? And the reason is because if we're breaking out to the upside, we can trade this in terms of a backside trade. So it will break out, back down, and then up again, right? If it was to break down to the downside, we can actually trade counter trend trade, because this area here may well be something along the lines of 50 to 100, 150 pips. So why wouldn't you take a counter trade trend? If London opens in the morning and it wants to go bearish, it's maybe coming down here to retest this accumulation or retest this level, pick up some more orders before it goes again, right? So I would generally trade with an open bias day to day, and that's for good reasons, because the distances between the two ranges, you've got the accumulation here, you've got the accumulation here, and in between these accumulations, the move is usually impulsive, and it doesn't then have any support. So you'll be seeing a range, an impulsive move, a range, impulsive move, and then a range, okay? So if we take a look at some different types of entry, okay? Basically, we've got an accumulation here and a breakout, okay? So there's a 30-minute method that I would use in terms of breaking out maybe without a retest, and you can see those videos again in other parts of the Discord, so I won't go into that in too much detail. This is more about the structure and the placement of my levels. So you've got the accumulation, and then an impulsive breakout where you can basically, so you basically have a 30-minute candle like that, the next candle comes down and blows through, right? And again, look for the videos in other parts of the course. The other type of accumulation is, you can see that we're failing to break above this level, right? But you'll notice that these highs are getting higher, so the structure is trying to move up, and as the more times it tests, and generally it will be, you know, the third or maybe the fourth time that this level gets tested, it will break out and then it will stall as if nobody knows what's going on. You might get a small little doji candle here, and then it will pull back and then break out and go again. And again, it will move maybe 100, 200 pips in that move. The third idea is where we actually come back for a liquidity grab. So we maintain our bullish bias, you know, because we're clearly in a bullish cycle, right? But however, we may come out to the downside, retest, move down, and this again could be about 100, 200 pips. Okay, so more than enough to get your 2-hour trade. And when we get to this point, obviously we're looking at this accumulation. The last thing you want to be doing is trying to trade through this accumulation unless there's a lot of volume and it just kind of goes and it doesn't stop. It doesn't happen all the time, but it does happen. So we look for the breakout, look for the retest, and then look to take a short, and then potentially, you know, if you miss that trade, we still got the option of when this, because we're still bullish, obviously, when this area is retested, if we get that GFX manipulation point style liquidity grab and confirming candle, so the confirmation can be either on the 15-minute or the 30-minute, we can then look to take longs and head up to maybe this area or any of these levels that we may have been created throughout the day. So let's take a look at one of the first options that I've got here, which is where we've got an accumulation, impulsive move, failure to break below this level. However, we're creating, we've got a high, lower high, lower high. Then we've broken out normally during Frankfurt, and then maybe around about London time we'll pull back and we'll get a breakout, a retest, and then an impulsive move down, right? This is a very popular trade of mine. I like the structure. I like the fact that, you know, if it's going to come down and it's going to be a liquidity grab, if you're trading that in that liquidity grab, generally speaking, it moves very quick, because it will start to entice buyers back into the market, because what you get is you get the breakout and then you get a break back in, and then you get a break back down. So it's created liquidity here. But the idea of it is to come down and take the liquidity from the lower levels, right? When it then gets down here, you'll see it will stall. Maybe it will stall from about 11 o'clock till about 1 o'clock in between London and New York. And that will be a reaccumulation. So you get a reaccumulation, and then normally around about 1:30 to 2:30, you'll see New York Stock Exchange open. They'll push down one more time, and then price will rocket to the upside. Okay, so that's one option. You've got short potentials from here, and then overall longer term bias would be bullish, so you've got buys from here. The other option is, again, and you'll have to look at my accumulation breakout entry video. Okay, we've got pretty much a square accumulation, okay, and you'll normally get a candle that breaks out like this, and it will close above. It will have a wick to the upside and obviously a wick to the downside. Now what you want to be looking for is the next candle to come down, respect the wick of the previous candle, and then as it moves bullish, it should generally take you with it if you've placed your stop order just above the previous wick, like I outlined in the videos. And again, take your profit 1, 2 hour. Sometimes you'll have a higher time frame target to the left that you can aim for, but not all the time. what you've got here, okay, is I'm not entirely keen on this entry, okay? So you'll get this kind of accumulation where price seems to be moving down. It will move out and then back in pretty sharpish, but then it will start to respect the low of this accumulation. There is a style of entry here which is, if you can look at it, it's like a head and shoulders pattern, but what I'd prefer is for this high to first of all break this high. Generally though, what can happen in this instance is that there's too much momentum and it would just break out to the upside, which we'll see in the next slide, and you may not catch the move, or there's not enough risk to reward. The risk to reward is out of sync, so you may have a stop loss that's too big, okay? So what I'd prefer to do in this instance is wait for the breakout and then wait for the retest, which is again what you'll see in the next slide. So you've got, again, a different scenario here. Still, we've got, you know, this could be market cycle phase 2 or market cycle phase 3. We've got the reaccumulation, but instead, this time of pulling back and grabbing any liquidity, you'll notice that the price just cannot break below this level, okay? Maybe you'll get a very small pin bar that just comes and takes out a couple of these wicks, but you won't get a closure underneath this level. And that's the first sign that you need to look for in terms of where is price going to go next, right? Because you still have lower highs being formed, so you don't really want to get involved in any longs prior to the breakout. But when it does break out, again, you'll normally get that retest here, okay? So you get the breakout, the retest, and then price will normally move 1, 2, or however many pips it is. So if you're aiming for 1-to-1, you can be very successful very quickly. You can have a pretty high win rate with 1-to-1, 1-to-2 less so, but I would highly recommend that if you're aiming for 1-to-2, when you get past 1-to-1, 1R, okay, you start trailing your stop loss to around about 1R, 0.8 or whatever. Okay, so that's option 3. There's a different variation again. Now, I wanted to go through with you some of the candlestick formations that you'll see in these instances, okay? So first of all, we've got short bias here. So we're going to take the break to the low of the manipulation point. What you'll generally see is you'll get, so this is more like a backside trade then, right? So the breakout will occur. You'll normally get like maybe a stall in motion on the 15-minute time, and this will be again between 8 o'clock, 8:30 when Frankfurt opens. London will generally start to pull back, okay? So you'll get people now being enticed into the market, and when price moves back in like this, okay, it starts to entice buyers into the market, which does what? It creates more liquidity. So the banks and the people who move the market know exactly what they're doing, because they're enticing sellers, okay? So sellers are now putting their stop losses here, okay? What they'll then do is they'll entice buyers, okay? And then what happens is you've got buyers in the market with stop losses here, right? So you've created liquidity here, and then London will come up, take that liquidity from the early sellers, okay? You'll notice here that there's 2 15-minute candles that have broken open and closed underneath the manipulation point. So they've opened and closed underneath, okay? That's the first sign for me that this level is not going to hold, right? You'll then get your pullback, liquidity taken from here, okay? Liquidity created down here, and then the first sign again is the wicks, okay? So the wick here, this wick won't break that wick, and then the second, third wick won't break that wick. Once we got this 15-minute confirming candle, right, we've then got a confirmation short. So even without using the Garmin box, you can tell that this is an engulfing. It's broken this level, it's closed in this lower 1/3. All you got to do is enter the trade. So you put your stop loss above the candles here, and you take, or you aim for your 1R, 2R trade. Now, on the 30-minute time frame, it's going to look slightly different, right? Because it's going to look like a breakout and then a fake out, and it's going to move back in. But there's a secret to reading these candles that I don't think many people in this market are being told, and maybe they don't know about it, okay? But I've noticed and picked up on this over the last maybe year and a half, and it's an incredible way of looking at the market from through a microscope. Okay, so it's not only the candles and the candle color that you want to be paying attention to, it's what's happening with the wicks. Okay, so we've got a low, right? We've got another lower high, lower high, lower high, lower high. Okay, so this is maybe Frankfurt, the original break. London wants to come back in and take some liquidity, but anyone trading on the 15-minute time frame, the liquidity's been taken. All right, the liquidity's been created, but on the 30-minute time frame, it doesn't look like that. It looks completely different, because you'll notice these candle wicks start following each other. Right, once you've got this kind of formation, right, so we've got now the creation of support or creation of resistance, whichever way you want to look at it. You'll notice that this candle will come back up, it won't break this high, it will form a new high, and it will close below. This is the most important level here, because once this candle opens, and you go through my candle anatomy tutorials, because I go on and on and on about this, and the more you see it, the more you learn. The more you overwatch it, the more you pay attention to it. When this candle opens, it opens like that. It will move up, okay? As long as it does not break this high, okay? You place a stop order here, okay? So your stop order goes below the candle, which is the bearish candle, right? So you got follow the highs, 1, 2, 3, 4, 4 new lower highs, okay? Wait for this candle to open, wait for it to pull back, and then as it passes the wick of the previous 30-minute candle, your entry is triggered, and again you move pretty quickly. Sometimes I've hit 1 hour in 4 minutes. Okay, so it can happen very quickly. When that volume kicks in about 7, 8, 9 o'clock, it can take you to your 1 hour in a matter of minutes. Okay, now I wanted to just flip it over and go through the same process with you on in terms of a breakout to the upside. Okay, so you'll start to get the basics of how price breaks to the upside. It kind of does the same thing, right? But again, 2 different time frames can be very difficult to digest. So it's best maybe to use the 15-minute confirmation first, because you could get the confirmation on the 15-minute at say 8:15, but a 30-minute entry would be a little bit lower down. But based on the 15-minute confirmation, you can enter the trade a little bit early with the anticipation that that trade is going to go in your favor and break the low of the 30-minute candle anyway. So in this instance, we've got the same scenario, just in reverse of what we've just spoken about, but I'll maybe talk about a couple of different things here. Okay, so first of all, we've got the breakout and then we stall. Okay, we've created this level here, which would be, creation of a new support. We notice is the candles obviously start following each other up, but then on the 15-minute time frame, not so much on the 30, on the 15-minute time frame, they start to reverse. Okay, then this is the magical part. What we've got here is we've got what I call reversal pins. Okay, once you notice this on the 15-minute time frame, you can move up to the 30-minute, because you have slightly different scenario on the 30-minute, which maybe give you a better entry. So if you've got a low and then a lower low and then a higher low on the 15-minute time frame, the expectation is that price is now reversing. Okay, because you can see the pattern of how these wicks are forming. It's not so much to pay attention to the size of the bodies of the candles and which direction they're facing in, because if you draw like a dot to dot on these candle wicks, okay, you'll start to see which way they're starting to go, because the next candle here will open up, it probably won't break this low and it will move up. Okay, so once you start to read the charts this way, you'll notice this. You can't take your eyes off it, and it will give you better entries, better risk reward, better consistency, and better win rate for sure over the time, as long as you're doing it the right times a day. So 6, 7, 8, 9 o'clock in the morning is a great time for trade in London. And then for me, 1, 2, 3 o'clock, they're all different variations there. It can get very choppy, and that's because New York opens at 1, New York Stock Exchange opens at 2 o'clock, and then 3 o'clock, I think it's like lunchtime in New York or something. So it gets really strangely choppy, and sometimes it goes in a completely opposite direction. So 3 o'clock, but there can be a lot of volume because a lot of orders get closed for lunch, etc. Now, if you pay attention here, you've got the reversal wicks. So you've got a low, lower low, and this can be green or blue. It doesn't matter if it's a support, a bearish support, or whether it's a bullish support candle. It makes no difference. It's probably better in respect of being a bullish candle or bullish in color. If we're bullish, it would probably be a little bit more higher success rate. But in terms of what color it is, it actually doesn't matter. What matters is the formation of the wicks and the new creation. So a new creation of a new high low. So we've got the low, the lower low, the higher low, the breakout of the high, okay, so the wick, and then as that breaks, the momentum then just takes it straight through. But what you'll probably notice on the 30-minute is it's not quite the same. You'll just notice that we've broken out, we've pulled back, we've maybe kind of stalled, nobody knows what to do, but you'll notice the wick follows the wick, follows the wick, follows the wick, follows the wick. We keep creating new higher highs as this trade is moving through the breakout. We get something maybe like this formation. Sometimes you get this formation on the 30-minute time frame, and this is more of a 1 hour formation. So use the 15-minute, the 30-minute, and the 1 hour, and just pay attention. Try and get this blueprint picture of what's happening inside the breakouts, and as price is moving, just try and get this kind of directional bias from the wicks, because to me the candle bodies don't make an absolute massive amount of difference to my trading, because we can get into this trade solely on the break of this high. So we move up, we break out, we've got a 30-minute closure above the level, so we don't want to be breaking out with a wick and then closing down here, because that's more of a rejection. You can move down to the 15-minute time frame. Maybe we've got 2 candles, so we break out, we've got 2 candles closed above, then we've got the pullback, then we've got the reversal wicks, and we're breaking out again. So that's a backside trade if you look at the PDF guide. And then if you look at the 30-minute time frame, it would be a pullback, maybe a bearish candle, maybe it will close above the level, maybe it will just it will close up here. It doesn't really matter, right? Once we get these wicks following and then moving in line, okay, we create support here, okay, so it comes back down. This will entice sellers into the market, so there'll be stop losses above here, stop losses above here, and when it reverses, the idea is that those stop losses are created when price goes against them. Your stop loss always seems to get hit so much quicker than your take profit, right? And that's because the market will create the liquidity here by kind of faking out that it's going to come back in and then blowing through those stop losses and taking those orders with it. Right. So I hope you've got some really good information here, right? I think that the general gist of it will be, so let's just run through it again. We got price will accumulate, it will move, it will accumulate, it will move, it will accumulate, it will move, right? We've got different variations of accumulation, right, before we pull back and go again. Manipulation points will be placed at the top and the bottom of the accumulations, right? Because if we're going to break out and go, we're going to move impulsively, because the creation of these orders in here, generally is quite something. It gives enough power to break out, and then it will accumulate again, usually late in the night, 4, 5, 6, 7, 8, 9, 10 o'clock into close, and then a little bit more accumulation before something happens in Asia, and then we come in London session and look to take advantage of the market again. Then it will move again, and then sometimes it will pull back and go which you'll see here. So breakout sometimes, and this doesn't have to be, you know, in unison. It can be any one of these three formations at any on any given day. So breakout, accumulation, breakout, retest, accumulation, and then reversal almost. So this is more of a backside trade down before we come into this to collect a lot more orders before we go again. And then we've got obviously the candlestick formations to look out for. So the 15-minute time frame on the breakout to the downside, and then we've got the 15-minute and the 30-minute breakout, you know, guide for the candles to the upside. So I hope this helps you guys. I hope you get some good value from this. Maybe you want to watch it a few times. Watch it the first time. This is my general advice to anyone that's looking to learn. Watch it the first time without a notepad. Just watch through the video the first time. Watch it without a notepad. You'll know some things which have already stuck in your head, but the second time you watch it with a notepad and write the things down that you don't understand fully, and go over them in more detail. Ask me some questions in the chat room, and maybe I can do another couple of little videos if need be. And then, yeah, just practice, look over the price action, place your manipulation points. But more importantly, and I can't stress this enough, right? You'll notice I do a lot of videos. I'll do a review video, I'll do an analysis video, I'll break down the trade when it's been taken, whether sometimes it's a win. I struggle to review losses because sometimes I gotta go for a short walk. But yeah, those videos combined with me and the ability to talk to me every day in the chat rooms and share your chart pictures, and then coupled with your own previous knowledge and the education content that's inside Discord already, there's hours and hours and hours of it, right? If you combine all these three and put it all together, there's no reason why you're not going to be a very successful trader in the long term, right? I've not ever failed to create a long-term consistent trader. I don't think anyone has ever paid to come into this group and left a non-consistent trader or a non-profitable trader in some way, shape or form. So take advantage of this environment. Okay, I'm here every single day. I love to educate people, and if you work hard, I'll work twice as hard to help you get to where you want to go. All right, guys, thanks for watching. See you in the next video.